You've been doing it wrong this whole time. You're putting money in your savings account every month, watching that balance grow, feeling responsible, feeling secure, and you're actually getting poorer. Not in nominal dollars. Your account says 30,000, 40,000, maybe 50,000. But in real purchasing power, you're losing money every single day. Let me show you something that's going to make you angry. If you saved $50,000 over the last 5 years in a typical savings account, earning 0.5% interest, you didn't actually save $50,000. After inflation, you have the purchasing power of about $42,000. You worked your ass off to save $50,000, and the market took $8,000 of it while you were sleeping. That's what we're fixing today. My name is Prime, and I spend way too much time thinking about why people who think they're being responsible with money are actually making some of the worst financial decisions possible. If you're someone who's been told to save, save, save your whole life and you're wondering why you're not getting ahead, make sure to hit that subscribe button and give this video a thumbs up if this changes how you think about money. Because here's the truth, saving money is not a wealth building strategy. It's a wealth preservation strategy at best, and a wealth destruction strategy at worst. Let me explain. Here's the thing. We've been conditioned to believe that having money in a savings account is safe. And look, I get it. There's psychological comfort in seeing that number go up, and knowing you can access it immediately if you need it. But safe from what? Safe from market volatility? Sure. Safe from inflation? Absolutely not. Let me give you the actual numbers, because this is where most people's brains short circuit. The average inflation rate over the last 20 years has been about 2.5% per year. Some years higher, some lower, but let's use 2.5% as our baseline. The average savings account interest rate right now? About 0.5%. Even high-yield savings accounts are giving you maybe 4 to 4.5% in 2024, and that's a recent development. For most of the last decade, they were under 1%. So here's what's actually happening when you save money. Scenario 1, traditional savings account, 0.5% interest. You save $10,000. After 1 year, $10,050. Inflation eats 2.5%, you need $10,250 to maintain the same purchasing power. Real value of your money? $9,798. You lost $202 in purchasing power. Scenario 2, high-yield savings account, 4% interest, you save $10,000. After 1 year, $10,400. After inflation, $10,250 to maintain purchasing power. Real value, $10,146. You gained $146 in purchasing power. Even in the best-case savings scenario, you're barely keeping pace with inflation, and the moment interest rates drop again, which they will, you're back to losing money. Now, you might be thinking, okay, Prime, but at least I'm not losing money in the stock market. And that's where you're wrong, because over any 10-year period in the last century, the stock market has averaged 10% annual returns, even accounting for the worst crashes, recessions, and bear markets. Let me show you what that same $10,000 would do. Scenario 3, S&P 500 Index Fund, 10% average annual return. You invest $10,000. After 1 year, $11,000. After inflation, $10,725 in real purchasing power. You gained $725. That's not a small difference. That's the difference between wealth building and wealth erosion. And here's what really gets me. People will keep $50,000 in a savings account just to be safe, while inflation quietly steals $1,250 every single year. That's $12,500 over a decade. Just gone. Look, I'm not saying you should have $0 in a savings account. That would be stupid and irresponsible. Here's what a savings account is actually for. 1, your emergency fund. You need 3 to 6 months of living expenses in cash. This is non-negotiable. This is for real emergencies, job loss, medical crisis, car breaks down, roof caves in. If your monthly expenses are $3,000, you need $9,000 to $18,000 in an actual accessible savings account. 2, Short-term goals, less than 2 years away. If you're saving for a down payment and you're buying a house in 18 months, that money needs to be liquid and safe. Savings account. If you're getting married next year and you need $15,000 for the wedding, that goes in savings. 3, that's it. That's the list. Everything else, every dollar beyond your emergency fund and short-term goals, that should be invested, not saved. Because here's what most people don't realize. The opportunity cost of keeping money in savings isn't just the interest you're not earning, it's the compounding you're missing. Let me show you something that's going to make you physically ill if you've been hoarding cash in savings for years. Let's say you have $40,000 sitting in a savings account beyond your emergency fund. You've had it there for 5 years because you don't know enough about investing, or you're waiting for the right time, or you don't want to risk it. What actually happened? Savings account at 0.5%. Year 1, $40,200. Year 2, $40,401. Year 3, $40,603. Year 4, $40,805. And year 5, $41,008. You made $1,008 in interest, minus inflation stealing about $5,000 over that period. Real value, $36,000. If you had invested in an S&P 500 index fund, year 1, $44,000. Year 2, $48,400. Year 3, $53,240. Year 4, $58,564. And year 5, $64,420. You would have made $24,420. After inflation, real value, about $59,000. That's a $23,000 difference from one decision made once. And it gets worse because those numbers don't account for the fact that you probably kept adding to that savings account. Let's say you were adding $500 a month. Savings account over 5 years, total contributions, $40,000 plus 500 times 60 months equals $70,000. Ending balance with 0.5% interest, around $71,800. After inflation, around $64,000 in purchasing power. Real gain, minus $6,000. You lost money. Invested in index funds over 5 years, same contributions, $70,000 total, ending balance with 10% average return, around $89,000. After inflation, around $82,000 in purchasing power. Real gain, plus $12,000. That's an $18,000 swing. That's a car. That's a year of rent in some cities. That's a life-changing amount of money you left on the table because you were being safe. Here's where it gets really interesting. This isn't even about being greedy or taking huge risks. This is about basic financial literacy and understanding how wealth actually builds. So why do people do this? Why do intelligent, educated people keep tens of thousands of dollars in savings accounts earning nothing? Because we've been conditioned to fear volatility more than we fear opportunity cost. Think about it. If the stock market drops 20% and your $50,000 becomes $40,000, you feel that loss viscerally. It's in your face. You check your account and see the number went down. Your brain screams, "Danger!" But when inflation quietly erodes $1,000 of purchasing power from that same $50,000 in your savings account, you don't feel anything. The number still says $50,000. There's no red alert, no panic, just slow, invisible wealth destruction. Psychologists call this loss aversion. We feel the pain of losses about twice as strongly as we feel the pleasure of equivalent gains. So we avoid the visible loss, market volatility, and accept the invisible loss, inflation erosion. But here's what you need to understand. Over any 10-year period, the stock market has never lost money, not once in the last 100 years. Every single 10-year rolling period has been positive. Yeah, there are bad years. 2008 was brutal, 2022 was rough, but if you stay invested, you recover and then some. The risk of investing isn't actually risky if you have a time horizon longer than 3 to 5 years. The real risk is keeping all your money in cash and guaranteeing that inflation will destroy your purchasing power. All right, so if savings accounts are basically wealth destruction machines, what should you actually be doing with your money? Here's the hierarchy I want you to follow, in this exact order. Level 1, build your emergency fund, $5,000 to $15,000. This goes in a high-yield savings account. This is sacred money. This is your life won't collapse if something goes wrong fund. How much? Minimum $5,000 if you have stable income and low expenses, up to 6 months of expenses if you have variable income or high financial obligations. Level 2, employer 401k match up to the match. If your employer matches your 401k contributions, you contribute enough to get the full match. This is a 100% instant return on your money. It's the best investment you'll ever make. Level 3, pay off high-interest debt, above 7%. Credit card debt at 20%? That's an emergency. Pay it off before you do anything else. You cannot out-invest 20% interest. Car loan at 8%? Pay it off. Student loans at 9%? Pay them off. Anything above 7% interest is costing you more than you'll likely earn in the market. Kill it. Level 4, max your Roth IRA, $7,000 per year. This is tax-free growth forever. Max this out every single year if you can. This is where you build serious wealth. Invest it in low-cost index funds like VTI, VOO, or a target date retirement fund. Set it and forget it. Level 5, max your 401k, $23,000 per year. After the match, come back and max out the full contribution if you can afford it. Tax-deferred growth is powerful. Level 6, taxable brokerage account. Everything else. Every dollar beyond your emergency fund, retirement accounts, and high-interest debt, invest it in a taxable brokerage account. Same strategy. Low-cost index funds. Long-term hold. Let compounding do the work. Level 7, real estate or alternative investments, optional. Once you've maxed everything else and you have substantial capital, you can explore real estate, private equity, or other alternatives. But this is advanced. Most people never need to get here. Notice what's not on this list. Keep $50,000 in savings just in case. Now, you might be thinking a bunch of things right now. Let me address them. But Prime, what if I need the money and the market is down? That's why you have an emergency fund. That's why Level 1 exists. If you need money for a true emergency, you pull from the emergency fund, not from your investments. And if your emergency fund gets depleted, you rebuild it before you go back to investing. The hierarchy exists for a reason. But what if there's a crash and I lose everything? You won't. Unless you panic and sell, which is the only way to actually lose money in a crash. The market crashed in 2008. If you stayed invested, you recovered by 2013 and then made massive gains through 2021. The market crashed in 2020, COVID. If you stayed invested, you recovered in 6 months and hit all-time highs by 2021. The only people who lost money in crashes are people who sold. The market always recovers. Always. But I don't know how to invest. It's too complicated. No, it's not. You're overthinking it. Open a Vanguard, Fidelity, or Schwab account, buy VTI, Total Stock Market Index Fund, or VOO, S&P 500 Index Fund, set up automatic investments, done. You don't need to pick individual stocks. You don't need to time the market. You don't need to watch CNBC. You just need to invest consistently and leave it alone. But what about taxes? Roth IRA, tax-free forever. No taxes on gains. 401k, tax deferred. You pay taxes when you withdraw in retirement at likely a lower rate. Taxable brokerage accounts are completely liquid. You can sell and withdraw anytime. Yes, you'll pay capital gains tax, but you'll still walk away with gains. Roth IRA, you can withdraw your contributions, not gains, anytime, tax and penalty free. You're not locking your money away forever, you're just putting it to work instead of letting it rot in savings. Let me show you what 30 years of saving versus investing looks like, because this is the math that changes lives. Person A, the safe saver, saves $500 a month in a savings account, 0.5% interest. Total contributions over 30 years, $180,000. Ending balance, $189,000. After inflation, 2.5% average, $94,500 in today's dollars. Real wealth created, negative $85,500. Lost purchasing power. Person B, the investor, invests $500 a month in index funds, 10% average return. Total contributions over 30 years, $180,000. Ending balance, $1,130,000. After inflation, $565,000 in today's dollars. Real wealth created, plus $385,000. That's not a typo. Person A ends up with less purchasing power than they put in. Person B builds over $500,000 in real wealth. Same discipline, same $500 a month. One decision, save or invest. And this is why I get frustrated when I see people with $60,000 in a savings account telling me they're being responsible. You're not being responsible. You're being financially illiterate. All right, here's exactly what you need to do starting today. Step 1, calculate your emergency fund target. Monthly expenses times 3 to 6 months equals your emergency fund number. Keep this and only this in a high-yield savings account. Step 2, move everything else. Every dollar beyond your emergency fund needs to be invested. I don't care if it's $1,000 or $100,000. Get it out of savings and into investments. Step 3, open investment accounts if you haven't. Roth IRA with Vanguard, Fidelity, or Schwab. 401k through your employer. Taxable brokerage with Vanguard, Fidelity, or Schwab. Step 4, choose your investments. Keep it simple. VTI, Vanguard Total Stock Market, or VOO, Vanguard S&P 500, or a target date retirement fund. Set it and forget it. Step 5, automate everything. Set up automatic transfers on every paycheck. Emergency fund first until it's full, then 401k to get employer match, then Roth IRA, then taxable brokerage. Step 6, never touch it. The market will go up, the market will go down. You will feel panic. You will want to sell. Don't. Just don't. Stay the course. Time in the market beats timing the market. Every single time. Here's the thing nobody wants to hear. Your fear of investing is costing you your financial future. It's not the stock market that's risky. It's not compound interest that's dangerous. It's your own psychology. It's your own inaction. Every year you keep money in savings instead of investing it, you're making a choice. You're choosing certainty over growth. You're choosing comfort over wealth. You're choosing the illusion of safety over the reality of financial independence. And I get it. The stock market feels scary because the losses are visible and the gains are abstract. But inflation is scarier. Inflation is the guaranteed destruction of your purchasing power. Inflation is the silent thief that steals from you while you sleep. The stock market might go down 20% in a bad year, but over 30 years, it goes up 1,000% plus. Inflation goes up 100% over the same period, meaning your cash loses half its value. So which is actually riskier? Look, there are exactly 3 scenarios where keeping large amounts in savings makes sense. Number 1, you're buying a house in the next 1 to 2 years. Down payment money needs to be liquid and safe. Keep it in high-yield savings. Number 2, you're within 5 years of retirement. At this point, you should be gradually shifting from stocks to bonds and cash to reduce volatility. This is normal and smart. And number 3, you have a major life event coming. Wedding, baby, medical procedure, etc. If you know you need $20,000 in 8 months, that money stays in savings. The timeline is too short to risk market volatility. Outside of these 3 scenarios, there is no good reason to hoard cash in savings accounts. Stop saving money. Start building wealth. Saving is what you do with your emergency fund. Investing is what you do with everything else.
The comfortable, safe choice is to keep money in savings. The smart choice is to invest it and let compound interest work for you instead of inflation working against you. In 30 years, you're going to be so much happier that you made the uncomfortable decision today. If this video changed how you think about money, hit that like button, subscribe to the channel, and share this with someone who needs to hear it. And drop a comment. How much do you currently have in savings that should probably be invested? Let's hold each other accountable. Thanks for watching. I'll see you in the next one.